I mean, I do a lot of fitness-oriented kinds of things. You have to like put in energy to get energy. I invest in my spiritual life, those are I think the things that sort of keep pace.
Welcome back to another episode of Tank Talks. I'm your host, Matt Cohen. It's been an incredible year, and I'm so grateful for our growing community. We've had some amazing guests, including NBA superstar Baron Davis and inspiring founders like Dax Da Silva from Lightspeed. But none of this would have been possible without my partner in crime, John Ruffalo. John's been here through it all, breaking down the biggest headlines and sharing valuable insights every step of the way. Before we head into 2025, I want to pause and revisit a few standout moments from this past year. We explored new trends, dug into fresh ideas, and heard some downright honest advice that can give you a head start on whatever comes next year. So settle in and let's celebrate the best of 2024 along with the lessons our guests shared to help you crush it in the new year. If you want to dive deeper, don't forget to check out all our past episodes at Tank Talks on Substack or LinkedIn or wherever else you want to follow us online. Thanks for sticking with us, and here's to an even better 2025. Baron Davis, I got to ask, what is your favorite podcast?
I'm not one that listens to full podcasts. I listen to people like, this is a dope show. And then I'll listen to All the Smoke. And then I'll listen to, Lewis Holmes. Then I'll listen to Earn Your Leisure. And so I kind of like bounce all over the place. I probably need to have like a dedicated person or dedicated place. But I just kind of like to check, what everybody is doing, because I like to get my information and like, it's like the cadence, the vibe from everyone.
Yeah, I mean, you obviously follow a lot of the newest trends out there. What are some of the newest, or what's your favorite new trend that's happening out there, whether it's in, terms of athletes, content, AI or something?
I mean, obviously AI is just like going crazy, but I think like I'm loving what's happening with like AI, VR, AR, digital mapping, environmental mapping, AR, like tokens. As you know, I love crypto. I created the OATMills, which is like our own, think like Bored Ape meets Wu-Tang. That's what we always say.
Yeah.
But, to be able to put on a headset and walk in this mixed reality world and be at, one of our concerts or festivals, or be at one of our basketball games or all-star games, right? Be at a comedy night. It's like a serviceable person that you're building to build a world for people to like be able to come in and let their guard down. And then also like on, just the prompts and business side, as far as like archetyping what a new company would look like, or deep diving on, hey, if I had my own sports gym, these are the things that I would want, and having, really like that digital assistant to really help give you the information you need. But it's the VR and the AR stuff that we're most excited about, because we have, a lot of content and a lot of things coming. So, it's going to be great to be in that space. And then the last one is, I would say, digital asset protection, thinking about, what we've built and what we have and, the people we know. As people start to scramble and try to find who's going to be the right partner for their digital asset management rights, we're going to be there to basically bring them up to speed. And it's not how it was before, you know what I mean? And so creating onboarding experiences where the creator is their own storage mechanism for storage and distribution, and collaboration.
Yeah, absolutely. Take a lot of the ownership back. It makes a lot of sense. What is one of your favorite or most influential books that you've read over the years that impacted your thoughts?
It's always Rich Dad, Poor Dad, just because just baseline values of, financing.
That's a great one.
It's a great book. I'm trying to think of my favorite Malcolm Gladwell book.
Tipping Point?
You could say, yeah, Tipping Point was good. Yeah, I felt like the tipping point, I was living as I was reading it.
True. The broken window effect for sure. But I think, there's probably Talking to Strangers, Outliers, Blink. I'm sure there's a bunch
Outliers. That was the one.
Outliers?
I loved.
Okay. And last but not least, I got to ask, what's your favorite life lesson that either your grandfather shared with you or someone in your life that you still carry with you today?
Be happy for the things you have. Be happy for the people that are in your life, and you can't control what other people do. And so walk your walk, talk your talk. Good people. If you are a good person, you will attract the right good people around you.
Nicolas Mulroney, President and CEO of Bond Bakery. What's the best piece of advice you ever received, either from your dad or someone else in your network, that you'd like to pass on to our listeners, personal or professional?
The best advice I got from my dad, I don't think it's anything that, you're going to put up in any inspirational billboards or anything like that. It was just so timely. When we met, when we ran into each other and I was pitching any investor that would listen to me, I was buying a bakery on the other side of the country, an industry that I had no idea about. The cannabis industry could raise any dollar that they wanted, and gluten-free was like my headwind. And so everybody was thinking, like, what are you doing? Here I am trying to buy this, this boring bakery. And we went to over 80 groups and we heard over 50 no's. And my dad just told my partners and me, he goes, it's an election. You have to win. It was the decision that we made to go into it. There's no other option. And looking at it now, it was right. We had to figure out a way to make it work. So while we heard all of those no's, and we learned a lot during that time, like we look back and yes, it's an election, you have to win. It's not going to be on any pillows or any, any inspirational posters, but to us, it was so timely and it captured what we needed to do at the moment. So I look back and that was pretty impactful.
It's a mindset that he was sharing and that he had, obviously, when it came to any sort of big decision or any decision really you had to make. That's fantastic. Before we wrap things up, we always ask our guests for their fast favorites. So first off, your favorite podcast.
How I Built This.
Any specific ones?
He's actually done a couple bakery ones. So you can actually...
I can't wait to hear you on that one. This will be a warm-up for that.
There was Dave's Killer Bread. So there's a few good ones.
That's awesome. Next is your favorite newsletter or blog.
This one... Probably no surprise, New York Times Deal Book. Every morning I get all the information I need. So there it is.
Still read it, huh?
Absolutely. Still relevant.
Favorite tech gadget?
My phone.
Nice. Favorite new trend?
I love this Ozempic factor. I'm fascinated to see what's going to happen long term. I'm fascinated.
Why are you so fascinated by it?
Well, like it's really enhancing the way people live their lives. Like, is it diet plus exercise? Is exercise picking up? Is it how they eat? When I think about my business, I wouldn't say that it's a near-term headwind, but it's certainly a long-term consideration. So as I plan my business in the long term, it's a trend that I certainly follow. So yeah, the Ozempic factor would be.
Next is your favorite book.
The Outsiders by Thorndike.
I've not heard that one on the podcast, but definitely an oldie but a goodie.
Yeah, I bought a bakery. I had no idea what I was doing. So from banking to baking, like that's one where it got me to think like, yeah, I could actually, buy a business in an industry that I have no idea and maybe make it work. So.
Yeah. And this one, I'm sure you've got dozens, but we'll try for your favorite life lesson.
I love Arnold Palmer's old saying. It's a funny thing. The more I practice, the luckier I get. And hard work, determination, but every once in a while you get lucky. I got lucky when my co-founder quit his job and moved to Vancouver. That really changed things around. But, it's like put myself to be in that position. So yeah, the more you practice, the luckier you get.
Winter Mead from Coolwater Capital. Getting into the nitty gritty a bit, what criteria do you use to kind of select the VC that you accept into the build program? And what does the 8-week process look like, during that training program?
I think of the world in terms of like basically two buckets. There's the emerging manager criteria and the institutional criteria. So when I was at Hall, when I was helping build the fund of funds at SAP, Sapphire, that is, I would say, more institutional criteria, right? Like you need to hit more check boxes in order to like meet the hurdle and get into the portfolio. For Coolwater, what we're trying to do, right? Like you asked about the mission earlier, is support the innovation economy by supporting emerging managers, right? And so I think we have to be more flexible with our investment criteria. And I wouldn't even call it investment criteria. It's like trying to support people we believe are going to be long-term oriented fund managers, acting as fiduciaries, like, being stewards of LP capital, and they're great investors. And so we're looking for, again, great investment acumen. Like you have to have some pattern of investment. Like it could be an angel, you could be working at a smaller VC, you could be working at a bigger VC, like you could have gone through the apprenticeship model, you could have worked at a VC-backed company, right? And like what VC is, like it's this very specialized high growth technology investing strategy. Kind of have to have that background of like knowing what VC is through investing or through operating. That's really key because again, I think VC is just one of many models in which you can like make money as an investor. But that's a key point. Like even if you're an emerging manager, like you can't be an emerging manager in VC if you don't have the background and exposure to VC in the past. And so that is something that's like we look for. Also looking for, I'd say a bias towards like management. Again, fund manager, like management, you have to be kind of biased towards managing the fund. This is probably why when you're talking to your, GPs in the past, like these people were trying to push you away from it because it is a management exercise. And outside of Coolwater, I don't know any other program on earth that actually like helps you get an MBA or get like a management degree for running a fund. Right. And so it's looking for someone that's aligned with that wants to do that, because there is a difference between angel investing and fund management, a big difference. Right. And like to your point, like everything you mentioned on the legal, the tax, the compliance, the back office, that's all management. That's not like investing. And like the angel stuff is like investing. The fund management stuff is, now you're starting to get into the kind of nitty gritty. You need to be aligned there. And I'm looking for that. I would say I also challenge people, do they want to be fund managers, especially if they're angels, right? Because probably being an angel, it's arguably less work. It's definitely less work than being a fund manager. So it's really something you kind of want to be like, aligned long-term around if you want to do the fund manager game. And then I'd say, community orientation does help, right? Like it does seem like there's a certain personality that kind of qualifies for the Coolwater community, where if you just want to be a lone wolf, like that's fine. Seen some people be successful doing that. I think if you buy into the fact that you can get further by growing the pie bigger, that is like the community element of Coolwater. Like it does seem like we're looking for that as well. Like we want people that, again, are going to run great businesses, and not make bad business decisions, but they are going to have that personality that's a bit more like community oriented, because like, if the pie is bigger and everyone's sharing in a piece of that larger pie, that's actually attractive than if like you just kind of stay small and kind of insulated. Again, I think both models can work, but I think for Coolwater, like we're looking for that on the emerging investment criteria. And then the last thing I'll kind of touch on is like, don't need all the boxes checked. Fundamentally, we're looking for someone that has like, again, really strong experience in VC, right? That doesn't mean like DPI, that doesn't mean like a 10-year track record, but someone that like has a right to win deals and can like pick and win access into great deals. And then we want to like work with them and just see like, is this something they want to do longer term? That's the point of like that core program for build. And then again, we don't think you need to know everything coming in. So we have like this huge kind of like alignment around like institutional criteria, and we can help you go from like that emerging criteria, like that, you're great, you're special, there's something here that may give you a right to win. We can help you kind of bridge the gap between the emerging and institutional, right? Which makes you eventually, hopefully sooner rather than later, more attractive to institutional LPs. And yeah, that core program, runs over 2 to 3 months. The kind of 3 big pillars are fundraising, what I just mentioned on fund management, and operations in reverse order. Like you got to get the ops kind of set up initially. Like you don't want to build too much. You don't want to build too little. You kind of want to build like the Goldilocks version of your fund, especially for fund one, so that you're not wasting money, you're not wasting time, you're not under optimized, like you are optimized. Then the fund management stuff, there's all these new concepts that come up. Like you go from angel to fund manager, these new concepts of portfolio construction, other things like you need to know. And they're critically important, right? It's like learning a new language. Like you can't go to a country that speaks a different language and like you expect to just like everything's just going to like flow like very smoothly. Like you have to like learn the new language of being a fund manager and understand like these new business processes that are core to you running a fund. And then lastly, on the fundraising piece, it's like, how strong is your fund product? Do you understand the full market? I met with 1,010 fund managers last year. That's a big number. Not all of them are going to be successful in raising their fund. You need to know, like, did everyone else meet with 1,000 managers? Probably not. But like if you meet with 1,000, you have a perspective of what the market looks like. What is the top 10%? The top 10% of 1,000 is 100 managers. What's the bottom? Most people meet with like 100 or 200 managers. So is that the bottom 20% or is that the top 20%? Right? Like you're missing 800 to 900 names. And that's like, I don't even think I saw the full market. So I think like for me, I think that fundraising piece is, it's when I say strategic positioning, it's understanding like where do you sit relative to all the other funds out there? And do you have a perspective to make yourself better?
I've seen it. I've seen it too. Like I'm an LP in half a dozen funds as well. And I tell them the same things you're saying. Is like, do you want to be an angel investor full time or a fund manager full time? Because for me, managing a full team, doing, quarterly reviews on employees, having all these LP conversations, putting all the reporting together, having weekly calls with your fund admin and your CFO and your taxes and your legals, like that doesn't even scratch the surface on the investing side, which also dedicates a huge part of time. So it's a crazy different world between a fund manager and just an angel investor. What we venture tourists.
Are you becoming your mentors? You're telling other people not to start funds in this market
No,
environment?
never. I'm doing the same thing I tell our founders, which is just, no, it's going to take twice as long as it's going to be 5 times as hard. So just be prepared. That's all it is.
Yeah. That's bigger. I was saying, it's for the fundraising market, 2024, it's like, versus 2021, it's like twice as hard. You're going to raise half as much, but maybe it's like 3 times as hard and raise a third as much.
I would never tell anyone not to do anything that they set their mind to. I would just like to give them the guardrails or the truth around what it's going to be like so that they can maybe just see around the corner, which it sounds like you're doing very well with Coolwater.
You don't want to discourage people. This is some people's life's dream and you have to encourage that. And again, the point of this Coolwater build program is to help give you, again, the greatest probability of manifesting that dream. That's the point of it. And again, some people, a super minority, but some people have decided I actually like angel investing. I just, someone came into the last cohort, writing 100K checks into angel deals, had the ability to do a big GP commit, have a really strong foot forward, in their own fundraising process. But they came to the program and kind of realized that they didn't want to be a fund manager and do all this other stuff that you're mentioning, right, on the management side. And they're oh, I'm all of a sudden becoming the CEO of my business, which is going to take 80% of my time. And all I want to do is invest. I'm having a lot of fun investing. And maybe they come back in 2 or 3 years and they kind of have a change of heart. But Coolwater program is intense enough for people to get to that decision, right? You can also as a team, you're maybe 2 people saying hey, I want to go through and see is this the partner I want to date in a very intense way that I'm going to spend the next 20 years with. And you force yourself to co-invest together. You force yourself to build together. And some people decide actually, this isn't the person I want to build this with. Let's split up. Or some people say actually, yeah, that confirmed my original hypothesis. This is the person I want to build it with. So you can use Coolwater in different ways, to kind of get to, similar outcomes. But yeah, the name of the game isn't to discourage people from realizing their dreams, especially if they have the background. They're going to be very helpful to founders, right? Because building a company just generally is hard. Founders of technology companies, they're kind of the core kernel of all of this, right? And the emerging managers are they're trusted partners that are kind of helping that company building journey for the tech founders go, more smoothly. I want to put more people into business that are helpful to founders. That's kind of the mission.
Yeah, I actually had some of our best founders provide feedback to me as an emerging manager on how to become a better startup founder as I was starting a fund for the first time. And it was incredible feedback. My view of this is that you're going to have real, true early stage venture capital still exist, like we are, pre-seed focused primarily as an institutional VC, but capped out at a normal fund size of 150, maybe even 200 million, but that's pure early stage. And I think on the other end of the spectrum, you're going to have these huge asset gatherers like we just saw with the new $7 billion Andreessen fund pool that was raised, but that trickles into 5 different sub-funds. And I think you're going to see a lot of assets go there. What I do think you'll see is the hollowing out of the 500 to say $1 billion generalist funds that are competing for all the same stuff at the Series A, B, and maybe C stages. And LPs saying they want more specialization of that asset class rather than just generalist. And the fund sizes there can get the same exposure if you just join a bigger asset platform like a Sequoia Andreessen or something else. What are your thoughts on that?
Yeah, I've been seeing kind of the bifurcation happen for the last 10 years where the barbell of you see the haves and the have-nots, and people say the haves are the asset gatherers, the bigger firms, with the tens of billions in AUM. That's definitely if you can do it, it seems like those firms do it. They keep on raising larger funds. Is the case there to drive outperformance, what venture is known for? Are you going to get the 5x fund by raising $10 billion? time will tell. But I think, my view and kind of where I'm putting eggs in the basket is, I think if you, do the right manager selection for smaller funds, that maybe 150 sub $150 million bucket you were referring to, like, I think if you're doing the right manager selection, partnering with the right managers there, we're able to navigate nimbly based on fund size, based on experience, based on acumen, the investment market. I think they're going to continue to build like attractive portfolios. And again, like there's so much capital that's has to be deployed into technology. I don't really think about it as like there's a mid tier there. You can mention the 500 to a billion. Like I always think that's going to be there. Like there's just always going to be bigger checks after the starting checks, right? So like where Coolwater spends its time mostly is like that starter category, right? Because like that's harder for discovery. It's harder to like understand the technology. It's harder to understand like before there's, product market fit, meaning like these technologies are actually commercialized and, selling to people. That's the hard piece still. I think there's always going to be like capital downstream. And so, yeah, if you have the opportunity to be an asset gatherer, you're going to most likely do that. Like that's what I've seen in 98, 99% of the cases. But for emerging managers, like you still have to be special and have a right to win, right? And that's what Coolwater is trying to focus in on and, invest into.
Yeah, I mean, I love what you're building and I love what you're doing for the ecosystem. So cheering for you and wish I was able to join a Coolwater when I first started out.
Never too late.
Never too late. All right, I'll apply to the next build cohort. Before we wrap things up, we always ask our guests for their fast favorites. First is your favorite podcast.
I mean, Tank Talks, All In. Like my wife loves the All In podcast, how I built this. Like some of these like ones where I think my favorite podcasts are the ones that like talk about like how something has been built.
Like Acquired FM guys on the Renaissance Technologies. Yeah.
Anything like that is like my favorite.
All right. Next is your favorite newsletter or blog.
Pretty boring here. I just go like with the standard rags that kind of like let me know just what's going on.
Strictly VC, The Information, one of those?
More like Strictly VC or like Term Sheet, just something that like gives me like the actual like what's going on in the business. And I spend maybe 5 minutes reviewing that in the morning.
Too busy. Next is your favorite tech gadget?
I'm on my phone for 4 or 5 hours a day. So
you're not reducing screen time, essentially.
Not reducing screen time, really. I think like without the mobile device, like given how much I traveled, I think I traveled like 40 or 45 weeks last year. Without the ability to do like remote work on a phone, it'd just be like impossible to run the business and actually like run as big of a community as Coolwater is now.
Amazing. A favorite new trend?
Either bigger firms buying smaller firms, which is starting to happen, or like the dance you do of peacocks mating when you're like merging, not emerging managers, but merging managers.
Very interesting trend. I think I know the answer to this one, but your favorite book?
I think the most like informative book for me as being an LP is like Pioneering Portfolio Management, David Swenson's thing. Like I've read it a couple times, and I do think it helps like that multi-asset class thing. Like reading that as a VC is helpful. Obviously, I think my two books are helpful: How to Raise a Venture Capital Fund, How to Set Up a Venture Capital Fund, and then some other like fun books like Catch 22 and books that kind of make you think about just the complexity of the world.
Yeah, absolutely. And last but not least, your favorite life lesson.
I think like doing something for so long where it like sheds all of your ego and gives you empathy. The experience of like having done Sapphire and like having like gone through the experience of like building something and then being able to like build a company around like that and like just have the empathy for something else that other people are doing. I don't know if that's a life lesson per se, but I think that's how I kind of like go through life. Like I'm always learning by doing.
Arthi Sharma and Satish Kanwar from Good Future. Obviously, the Canadian tech ecosystem is going through a lot of changes, and you guys are at the epicenter on reporting a lot of it through BetaKit and your other initiatives. I got to ask, Satish, first with you, what kind of trends are you observing in the Canadian tech ecosystem, whether good or bad? And, what do you think our listeners should be aware of?
The biggest risk to the future promise of Canada right now is our innovation agenda. Like our future economic prosperity is not predicated on the things in our ground or the things we can bring in from other parts of the world. It's predicated on our ability to be global leaders in what we export, what we create, the IP we have, the way we leverage our talent, and how we hone our capital and intellectual resources into incredible kind of solutions and technologies. And we're just in an era where there isn't enough kind of shared emphasis and understanding of like how much we're gambling with the key ingredients that make that stuff possible. those ingredients they're not just the tangible ones of like, yes, there's talent and talent risk of retention risk, but it's really just belief and optimism and people's encouragement that they should go start companies and they should take risks and that people will support them and that there's people are excited when people win and succeed at these things. The trends that I'm seeing kind of stem from a lot of the tangible behaviors that we're seeing of people worried about the tax increases, thinking about moving to the US, wondering about kind of if building AI in Canada has regulatory risk, all these things, they all stem from like, no one's sure if there's enough shared vision and trust to go do these things. There's never going to be 100% answers. It's about the environment, about the climate, about the feeling.
But uncertainty is the confusion and the kills innovation is what it sounds like you're saying as well.
Mm-hmm, absolutely. And so like this is probably the most critical time in my career that I've seen for kind of community confidence and way forward. There's parts of what we're doing that I hope will help it. But ultimately, the single biggest way any of us can make an impact right now is by helping build world-class companies here from the country, whether as a founder, as an investor, as talent around the table. If we go all in on doing that, the rest will figure itself out.
Yeah, passing it to you, Arthi, on community, what role does the Canadian tech community play in bringing the global attention back to Canada for the next decade?
Yeah, your initial question was around trends, and I gotta say there's this lovely new trend of people actually meeting up with each other. It stems from these young kids just graduating university, trying to figure out where to go, where are their community hubs, how can they continue that innovation cycle that they were in, pitching, making things, showing it to their friends, showing it to their community, getting feedback. I have to shout out the new demos team. I think what they're doing at that grassroots level and getting folks from the East End and, Waterloo and all that, it kind of reminds me of those early Jet Cooper days that we talked about, actual people building things, sharing it with others, trying to get users. I don't know if it's a trend, but I do think that is what's probably needed post-COVID. Satish, around your innovation agenda, I'm a little bit worried even after the whole taxation relief and all of those debates, that there are going to be people who are not close to the grassroots who are going to try to figure out what the solution is and put funds towards the innovation agenda. And I don't know if that's the way to go. If anything, I remember the debates around should we leave Canada? Should we not? Oh my God, we're all going to exit. The one thing that people kept talking about was well, we have healthcare here. That was the one value out of Canada. My stance on this is if policymakers or government or anyone actually want to do something for the innovation agenda, is they have to make it easier and more affordable to live here, especially for young people. And if they can't do that, please don't create another shitty grant system for entrepreneurs or some sort of bad AI credit. Please don't do that. Just make it easier for young founders to start businesses here and to make it affordable. That's what we need.
Yeah, we can't pay our way out of this, and we can't put up, these barriers to make it even harder to just get through every day while also trying to build the next Shopify, which everyone is trying to do. And it just becomes harder and harder. Could the next Shopify be built, in this decade versus the last decade? I don't know. It seems like it's a lot harder in Canada versus maybe somewhere else.
Yeah, I'm in such a D2C bubble, right? And so with a lot of the types of companies I work with, there is still that draw. We should move to LA. We have to move to New York. There's that ecosystem there. And so from my lens in the entrepreneurship communities I'm in, I do think we can build those out of Canada. Those founders just need more relief. It just needs to be more affordable to live here.
And I think that's the existential question. So
we'll save that for another podcast. But the last question I want to ask you both, first to you, Satish, what legacy do you hope to leave on the Canadian tech scene after all the initiatives you have going on?
I hope people look back and see the work we did and who we are as force multipliers for this mission. That, when times are good and when times are tough, there was good people that were fighting the good fight for that long-term prosperity of Canadian tech. And that's what I want to be all about.
I hope that we can leave a legacy of connecting. I think that there's a lot of different subgroups, ecosystems. We talked about those old family offices. I hope we can be the ones that are connecting these different communities. That's what I'd like to do.
Yeah, fantastic. And I'm so excited to have, a back seat to watching all the things that you guys are doing and a front seat through the Beta Kit eyes. So I appreciate that. Before we wrap things up, we always ask our guests for their fast favorites. So first off, with you, Arthi, favorite podcast?
I'm an armchairy, so I'm back to armchair expert. I took a year break and then I'm back in. I'm really happy. It's one of my favorites. And second in that is the Dream Bigger podcast by Sif. She's actually in our portfolio company. She owns a company called Array, and she has a podcast called The Dream Bigger. And I love to listen to it to get tips on how to be better.
Cool. You, Satish?
Amazing. Oh, podcast? I listen to the Acquired podcast a lot, typical, but I'm on hour 8 of the Microsoft episodes right now.
Oh,
and just,
man.
Loving it.
That's so good. I still think Costco is my favorite one. Those guys are fantastic.
Oh, I like the Hermes one.
Hermes was fantastic. LVMH too.
I like the LVMH one too.
Yeah, the LVMH one is really good.
So amazing. All right, next to you, Satish. Favorite newsletter or blog?
Beta Kit. Easy.
Okay. Same thing where you, Arthi?
My answer was Beta Kit too.
Easy.
Fine. Easy. All right. Favorite tech gadget, Arthi?
Tech gadget? I'm an Oura Ring gal.
Ooh. Okay. And let me guess. Satish's Whoop.
Yeah, I was once upon a time. I really like I'm Apple Watch now, but the Withings Body Smart Scale is incredible for
You talk about that all the time.
I've had every version for over, I think, 8 or 10 years now. And it's
what do you love about it?
It's the simplest solution to the step on something every day and get useful body metrics. And it's a habit, and it all Apple Health with your Apple Watch. It's daily, trusty, all the time.
Very cool. Okay, Satish, favorite new trend?
Oh, I talked about this at the town hall, rejection therapy. I love that new kids are figuring out about rejection therapy, self-help challenges. Every founder, you're a young founder, you got to figure out, every VC in Canada needs to say no to you first. That's just that's what happens. And you got to go through that. And then you're ready to come back to the table.
We tell our companies the same thing. Go practice 25 pitches on the ones you don't want to raise money from, and then you're ready for the good ones. How about you, RD?
I think it has to do with my hat, which is my new trend is companies actually making money. Yeah. Can companies make money now that we're post-COVID investing in everyone? I'm okay, let's start.
You show up to pitches wearing an EBITDA hat. I love it.
I just got it. I'm really happy about it.
Do you get it from a Shopify store?
I did, obviously.
Obviously. Okay, Arthi, favorite book?
Favorite book? Oh, this is so typical. My favorite book is any Jane Austen, but especially Pride and Prejudice. It's one book I'll always reread.
Fair enough. You, Satish?
A Toby recommendation earlier in my career, A Courage to be Disliked. Arthi knew this was going to be the answer.
Is that mandated across the Shopify verse or no?
It was on
in the library.
In the library, in the book bar. But it really
okay.
I'm a big fan.
Satish tells everyone to read this book.
It sets you free. You're just I'm in control of my own destiny.
I appreciate the consistency. And last but not least, Satish, your favorite life lesson?
Embrace naivety. So much of what we shared, we have no business, no experience, no history or track record or resume that suggests we should be doing those things. They come from a point of what we find interesting and going in with kind of wide eyes, not with this is the right way to do investing or family office or media or any of these things, but just being willing to be naive and hoping that leads to creative outcomes. So I used to really build a lot of mental walls of I'm not a product person. I'm not a VC. I'm not and nobody knows what they're doing. So just get out there and do it.
Coming from you, that means a lot. For you, Arthi?
Mine is from my dad, which is better late than never. And I think I'm turning 39 in 2 months. And so it's one that's on my mind, which is you can still do anything you want. There's no point to regrets. You don't want to be at that end of life whenever it comes thinking about all the things you didn't do because you thought it was too late. So better late than never.
Tom McCullough, Chairman and CEO of Northwood Family Office. Tom, what advice would you give to someone looking to start their own family office or wealth management firm actually today?
Don't focus on what you do well. Focus on what is needed. And that's what we did. And I'm sure we haven't captured everything in the world. So there's a great book by Adrian Slowatsky from Bain Capital called Demand. And he talks about just the idea of demand. If you can really figure out what is needed by the client, it is extremely helpful to create a great core lasting business. Maybe it's not going to happen quickly. Like in our case, it took, we're a 22-year overnight success, and look out there and, does the world need another money manager? Does the world need another wealth manager? Is there something that somebody is missing? And if you can fill that void, I think it's just got way more legs to it.
Yeah. And honestly, it's been rewarding to also have families that come to us maybe as their first, call when looking for family office managers and referring them to your group, knowing that, we're just a vertically focused, investment firm, but there are many more complexities that your team has experience in that a lot of new wealth family offices are looking for getting advice on. So that's been also exciting for our two firms as well. Before we wrap things up, Tom, we always ask our guests for their fast favorites. So first off, your favorite podcast.
Showcasing my nerdy tendencies. It's called The History of English. There's 160 episodes. I've listened to all but the last 2 or 3. They're an hour long, and it is unbelievably interesting. And the origin of words and where the English language comes from, where it's going, it's fantastic. For nerds, word nerds.
So I guess that makes my wife a nerd because she took Latin as a bird course in university. And I always ask her what the origins of the words are that sometimes we use. And she actually has a pretty good answer on it. But now ChatGPT has totally...
Yes. Well, she and I can bond over that.
Fair enough. Next is your favorite newsletter or blog.
Okay, well, this is a cheat. I'm going to say the Northwood Perspective. And I only say that because we really enjoy putting it together. We do this newsletter and we also do a reading list every quarter.
And a Netflix watch list or something.
And a Netflix watch list. And so I only say that because I'm not that much of a newsletter reader myself, but I cannot tell you the hundreds of people who say to me, this is really good. So
it's amazing. I will say it's amazing because I've shared it with a lot of family and friends after getting them. It's amazing. So please keep it up and don't take me off the list. Favorite tech gadget?
Well, it's boring, but I have to say iPad. I basically don't take my computer anywhere with me. I use my iPad all the time. And a second one would be Google Translate.
Oh, yeah. Nice. Where have you used Google Translate recently?
Oh, Japan. So, lots of languages. I speak, reasonable French and a little bit of German, and you can get by in lots of places. But in Japan, I couldn't get by at all. And it was just unbelievable. You hold it up over a menu and it just reads it in English. And it's just amazing.
Wow. And would you use it for them to speak back to you on as you're at the restaurant? Oh, I love that.
Crazy.
So cool. All right. Next is your favorite new trend.
Oh, a bit of a cheat also. The integrated advisor becoming an actual profession.
Pushing for that. I like that. It's really important. Next is your favorite book, and you can name your 2 written books or others.
I will not. I've used my 2 mulligan cheats. Well, I'll give you a fiction and a nonfiction. The fiction is The Plot Against America by Philip Roth. I love Philip Roth. It's actually been made into a movie. Classically, it wasn't as good as the book, but fabulous dystopian type book, and I loved it. Tough theme, but very good. And then my nonfiction favorite book, it's funny, it hasn't been bumped in many, many, many years, and it's called Made to Stick by Chip Heath and Dan Heath. And they talk about how most ideas we hear, most podcasts, most books, blah, 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 and a few of them are sticky. And what makes an idea sticky? And most people obviously haven't read the book because most people do blah, blah, blah.
Well, and last but not least, I'm sure you have many of these that you share with the families you work with, but your favorite life lesson?
Well, the first one that came to mind, embarrassingly, is from Dwight Schrute in The Office, is don't be an idiot. That was the first one that came to mind. But then I thought about it a little bit, and I thought, when you see people and you interact with them, you realize that a little tiny bit of their iceberg of their life is showing. And there's so much more down below. Hurts, difficulties, challenges, happiness. But you only see this little tiny bit, and they are so much more than that. And so the conclusion, and this is not because I'm good at it, because it's rather because I aspire to it, is show grace.
Partner at Stikeman Elliott, Mario Nigro. Mario, you obviously deal with a lot of high stakes M&A negotiations that could often fall apart at the very last moment after spending 3 months going through negotiations and due diligence and back and forth and high cost. How do you manage those complex situations and high pressure situations? And what advice would you have for some of the buyers out there that are also going through that?
Well, and it's really difficult because you spend months on a deal, months, sometimes 5-6 months. Your spend, after 5-6 months is incredible on the fees, whether it's lawyers and accountants and advisors, and then you have a worn out seller who, of course, is their advice. It's really hard in those moments when a deal starts to go sideways. And look, what I would say is, and I think it's underappreciated, most deal problems can be solved. I've seen very few that are insurmountable. Obviously, if a business isn't what you thought it was when you bought it 5 months later, you can't do the deal. When deals start to go sideways late in the negotiations, there is a responsibility, I think, as an advisor to almost double and triple check to ensure that the reason why this deal is sideways is because of miscommunication, misunderstanding. You wouldn't believe the amount of sometimes the dynamics, Matt, where people just get it wrong. And I thought he was saying or she was saying. One of the things that I think we have to be conscious of as advisors is when people spend that much time on a deal, they want to close. People say to me, Mara, they don't want to close. People don't spend 5 or 6 months on a deal and some issue comes up and you think that that's an issue not to close. I just think it's important in those circumstances to highlight not only the issue, but the relationship dynamics, because often that's what's really broken down.
Fantastic advice, Mary. Before we wrap things up, we always ask our guests for their fast favorites. So first off, your favorite podcast. Yeah, you can plug your own podcast here. Come on.
Oh, man, it's a great. I actually like your podcast. I actually do like your podcast, and I'm not saying that. I mean, if you want, but I actually do like.
I love your podcast too. I love the guests. Tell us some of the. Tell us your podcast name and what it's about.
All right, my podcast is called Views from the Market. It's a podcast focused on mid-market private equity in Canada, and it really tries to get mid-market participants. So it's not meant to go after the super big brands. It's meant to get what I call the real warriors of the mid-market. The sell-side advisors who are out there every day, the buyers out there every day, the real mid-market participants. So I'm really proud of that part of it. We are talking to the people who are doing the 2 million EBITDA sale, 3 million EBITDA, 4 million, 5 million EBITDA. We're not talking to people who are doing 500 million EBITDA. Nope, that's not what it's about. And it's short. It's 20 minutes an episode. I've done about 115 of them. And if you're interested in the middle market and some of the topics we talked about, I recommend it. Like I said, we've had a lot of good sell-side advisors, a lot of good buyers, a lot of good sellers on it, and they really talk about their experience in the middle market.
And it's a great community too of like people that the future buyers can lean on that you've obviously brought together.
I mean, some of the searcher stories are incredible on the podcast. So, you people who did, had no money, bought a company and turned it into an unbelievable amount of success.
Absolutely. Well, next is your favorite newsletter or blog?
New York. I'm a New York Times lover. Everything New York Times. So I spend way too much time on the New York Times. Way too much time. Way too much time.
Favorite tech gadget?
You know what? It's my AirPods 2, which sounds weird, but my AirPods 2. I use these things all day long. I don't know why I love them. And I've actually tried different ones. So it's not like I'm an amateur telling you. I've tried 4 or 5 different ones. AirPods 2.
Nice. Favorite new trend?
I don't know. I love the way TikTok has a reflective effect back on us. So I actually have become a big fan of TikTok because I've seen the impact it's had on my kids. And so I've kind of wanted to be engaged by it. And what I mean by reflective is people don't just watch TikTok, but then it becomes cultural norm. What comes out of TikTok becomes part of everyday conversation. And people say, where'd you get it from? TikTok. I find it fascinating, man. So I've become a big TikTok watcher, and I've kind of seen it now for myself where I'll say, I got it from TikTok. It's so cool because it's a whole other world that we didn't have when I was growing up. So I'm fascinated.
Favorite book?
English Patient. So it was a nonfiction English Patient. One more. Kafka.
And last but not least, your favorite life lesson?
I'm all in what I do, and if you're not all in, you can't expect the results. If you got to be all in. If you want it, you got to go for it. You got to be all in.
John Richtegard, Director of Capital at RBCX. Yeah, when I describe you, John, I describe you as the data guy in venture capital. I mean, going from Shopify to Gary Vee all the way into the mind depths of venture capital data is a hell of a run, but it's very awesome for you to be such a data mind in this ecosystem. What we're here to talk about today, though, John, is this very interesting piece that you just dropped called Spotlight on Capital Exited in Canadian Venture over the past decade. So maybe tell the audience a little bit about what inspired you to focus your analysis on the capital exited rather than the more commonly discussed capital invested in the Canadian venture ecosystem, and maybe when you even thought about this idea.
The origin story for this happened last Christmas, so it's essentially been a year in the running. And the reason why this all came about, even going back, was I was asked by one of our GPs, one of our general partners, a fund that we invested in. They asked me, John, why do financially minded LPs invest in venture when you think about how risky venture capital is perceived to be? And the answer I gave was quite straightforward. It was the fact that venture capital is the highest performing asset class if you invest in the best companies and funds. And obviously, if is a huge part of that. But more specifically, the reason why LPs invest in venture capital is because it has such a high degree of return asymmetry. And what I mean by that is venture capital is the only asset class that you can invest in whereby you can get 100x return on your money while only ever being able to lose 1 times your cost. But what's really important to remember in this context of asymmetry is to actually uphold that. You really need something we've spoken about a lot over the past few years as an ecosystem is this notion of capital efficiency, and specifically equity capital efficiency. And I'll give you the example as an example, right? Like if you exit for $100 million and you only raise $10 million in equity, your capital efficiency would be 10x. What's important to understand is, from my perspective, though people can talk about capital efficiency at a company level, I think it exists at an industry level as well. Meaning, if we produce $30 billion of exit proceeds across Canadian venture, for us to achieve a 3x on our industry, that means we can only allocate up to $10 billion of equity capital. Or if we've already allocated $30 billion of equity capital, we need to produce $90 billion in exit value to achieve that same 3x return. The issue that I was running into was I couldn't find any data set on capital allocated to Canadian venture over the past decade. Allocated meaning capital raised by general partners of Canadian funds by limited partners who are investing in those funds. And I also couldn't find a data set that actually looked at capital exited. So what my team did really over the course of the past year, our first report came out in June, and it was essentially a look back on the past decade of Canadian venture capital, but capital that's being allocated to the asset class. And so we're able to see, okay, how much money's actually gone in? And then this other report, which came out just yesterday, and kind of the blog post and publication was the first of its kind, which is looking now at capital exited over the course of the past decade. So when you bring this all together, I'm sure we'll get into it, but from my perspective, I think to understand the health of an ecosystem, most people, to your point, Matt, only ever focus on capital invested by VCs to startups. But from my perspective, I think to really understand the collective health, you need to understand all 3 capital vectors, being capital allocated, capital invested, and capital exited. And that was really the whole purpose of this report, to be able to shed more light on what's actually been the total capital that's been exited from Canadian venture and how does that relate to the amount that we've actually put in.
Right. And I think some of the ideas that you and I discussed was how people took over the headlines of billion-dollar exits or billion-dollar unicorn companies, but they forgot that there was $1 billion invested in the company to start with. So you're kind of, washing one hand against the other. And if you have a company, as you said, that raises $10 million, but exits for $100 million, that's a great 10x on capital efficiency and the exit value. But if you have a company that raises $1 billion and exits for 1.2, not so much. So I guess you picked a really interesting decade for this study to start and sort of wrap up. So can you kind of elaborate on what you found and obviously some of those spikes, both up and down, that you came across, and how you kind of thought about the snapshot in time and where you were pulling this data from and how that impacted some of the results?
So that's a big question. So I'll try to kind of compartmentalize what you said and answer it as eloquently as I can. I'll first say that the reason why this past decade is important is because it's the first time we've able to be actually to understand what the past decade of data looks like when you think about Canada having intentionally built our ecosystem since the Venture Capital Action Plan launched in 2013. So that was when we really started intentionally building Canadian venture. Now, when you look at where we are today, we're 10 to 12 years later. So we have a decade of data. So that's the first thing I'll say. The other really interesting thing to consider, though, is if you go back to the global financial crisis, it was the first time ever where the Bank of Canada took rates to near zero. And they essentially kept them there for the subsequent decade because they realized that inflation actually didn't spike past their 2% target. The way that I kind of describe this past decade, which probably makes it really unique, is we were almost on a travelator. For those that don't know what a travelator is, it's one of those moving walkways in airports. And we were on them when we didn't even realize we were on it. That's how kind of smooth things were going, right? Like capital was readily available, capital was cheap, valuations were high, asset prices grew. And so to your point, it was for sure unique when you think about the average interest rate over this past decade being close to 1 to 1.5% versus in the 80s, 90s, and 2000s in Canada, it was closer to 5 to 11%. So take that with a grain of salt, because I think that had a huge role to play from a macro perspective. Some of the interesting insights that we found from the data set. I think the first thing that was interesting to me that really stood out is one of the things we wanted to understand was how much exit value was generated in each successive year. And how was that exit value ultimately concentrated? 2020 and 2021, everyone speaks about those two being record years for liquidity in Canadian venture and huge anomaly years. 50% of the past decade's exit value in the Canadian venture ecosystem was generated in 2020 and 2021. That to me was remarkable. Maybe for some people it wasn't too crazy, but to think that 2 years of the past 10 were responsible for over 50% of the exit value generated made me kind of underscore the importance of market cycles. And as an investor, understanding where you are in that market cycle, and understanding as well that as an investor in 10-year illiquid funds, you need to make sure that you're having consistent capital allocation so that when these market cycles do hit, you can take advantage of them. One piece that isn't necessarily in the report, Matt, is we obviously do a lot of comparison to the US market. And what we found is 2020 and 2021, the data is identical in the US. It was also the 2 years of the past 10 where 50% of the aggregate exit value generated in US venture was also generated. So the big takeaway for me, point one, is holy cow, do market cycles ever have a huge impact when it comes to just venture capital liquidity and the performance of our asset class?
I mean, this is the famous quote that Bill Gurley mentioned, which is you can never time market cycles. You just got to enjoy it on the ride up as best you can and hopefully get off before it falls.
100%. You're bang on. And I actually reference, Bill Gurley, I read Above the Crowd, all this stuff. It's phenomenal. He kind of refers to the market cyclicality in venture to be not like a sine curve, but actually like a sawtooth wave. We have a gradual risk on investing period, a peak liquidity window at the top, and a sharp and abrupt risk off decline. And if you look at any data set, whether it's the invested numbers, the allocated numbers, or the exited numbers, it's absolutely holds true. The other thing I say that really stood out was, everyone talks about the power law in venture. It's probably like two of the most common words that everyone talks about. I was blown away as to how prevalent the power law is when you look at it from Canada's exit track record. One of the things our team did was we looked at all exits in Canadian venture over the course of the past decade that were over $10 million in size. So that's a little caveat. We don't look at the long tail, but the long tail from a value perspective is incredibly low, so it actually doesn't change the numbers gradually.
You said $10 million Canadian or US?
CAD. So in total over the past decade, we qualified 184 exits in Canadian venture that were at least $10 million and up. The reason why we chose that $10 million bound was because we needed to verify every single exit. What's interesting is of those 184 exits, the top 50 were responsible for 85% of the aggregate exit value. So to say this differently, those 184 companies over the course of the past decade generated roughly $56 billion in exit value. The top 50, 27% of the 184, generated $47 billion, which is over 84%, which is outstanding to me. The thing that I turned to when I first saw that data was, holy cow, is it ever important to be able to get a top 50 size exit outcome based on how much value is concentrated in the top 50 and how much of a smaller long tail we have, which is potentially just a function of, again, our ecosystem only starting to be intentionally built from 2013 now through where we are today.
What we're seeing, given that we make so many investments in Canada, is that we are investing in Canadian companies, incorporated in Canada, being built in Canada, but over 80% of their revenue and customer base is all US.
Yeah, I believe it.
Which I think is going to change a lot of the outcomes for a lot of these businesses, just like a lot of Canadian businesses take advantage, just being north of the border. Given all of these things that you've learned from this report and how some of this data is way more valuable than some of the other things we see often in the media, how do you think this extends sort of to the mindset of what GPs and emerging managers like myself should take away from it as they kind of put down their heads and try to build the next Shopify out there?
I think the thing for me that again, Matt, I've only been doing this for a short while, but the thing that I realized very quickly was how opaque private markets are. and specifically how opaque venture capital is. It becomes very difficult to learn about an asset class and to learn deeply about the asset class when there isn't a lot of differentiated reports, insights, and data, or just widely accessible reports, insights, and data. And so the first thing I want to say is the real reason why we wanted to put this out there was because I think there's a ton of value in being able to help democratize knowledge to this asset class, given how much I think venture capital will play in our Canadian economy over the course of the next 50 plus years. And so that was really the goal of being able to kind of help build something like this up. As it relates to investors, I think the thing that I'll say is really just about trying to help add different mental models and different tools for our Canadian investors and GPs to essentially hopefully try to benefit as to when they look at allocating, when they look at investing, how they can use some of this thinking in their own kind of day-to-day and embed it in the way that they ultimately run their firms. That's the other way that I probably think about how folks can kind of leverage this type of data.
It's so interesting because like those are the things I literally think about every day, every night. Waking up and going to sleep is like, how do you maximize these sort of frameworks of which we are sort of not confined to, but sort of operating within these like invisible rules of the game in ways that venture capital math works and ways in which our ecosystem is performing. Because, you know, as you and I have talked about in many of our conversations, like betting on businesses at sort of high entry prices, high US cost base, and hoping for a power law outcome doesn't really give you a lot of optionality. Like it's not the only way to really drive returns and success for your investors and for, you know, everyone involved, right?
Totally agree. I mean, I went through that at the beginning of the podcast, but like, again, people aren't necessarily venture capital for a median exit values, but if you take a $93 million median exit value and you own 10% of that business on exit, that's $9 million in proceeds. If your fund is, I don't know, north of $100 million and you have to try to 3x that fund, you have to try to do that 30 times over or find 30 times the amount of exit aggregate enterprise value, which is very difficult to do. So I totally agree with you. I think being able to be mindful about, as an investor, one of the things that I think about a lot, and it's a very kind of old saying, is the only thing you can control is entry price. Being very mindful and prudent about the things you can control, I think will only pay huge tailwinds when you're looking back on this 10 years later.
Yeah, absolutely. Well, thank you so much for putting this report together, John. It's everything we've thought about, but never really had the time or the data to actually articulate it as beautifully as you did. But before we wrap things up, we always ask our guests for their fast favorites. So first off, your favorite podcast.
Favorite podcast would have to be 10X Capital by David Weisberg. Great podcast for allocators.
We got to get you on there.
Well, you know, maybe one day we'll get there. I'm working my way up. I got Tank Talks here, right?
Maybe one day. Okay. This is the warm-up. Exactly. Next is your favorite newsletter or blog.
Big fan of the team at Altimeter, specifically Jam and Ball, specifically Clouded Judgment. A lot of really good stuff that he pumps out pretty much on a weekly basis and has been doing that for a long period of time. So love his work.
Yeah, fantastic one. Next is your favorite tech gadget.
Garmin watch. I'm a big long distance runner. Can't go anywhere without my Garmin. That's all I wear now.
Like what's an average distance run for you on a weekend? Just casually.
You know, between, I'd probably say 10 and 20K is kind of what I would try to get done as a longer run.
Just, yeah. All right. I'll be back in a bit. Just going for a quick 20K. Okay, got it. Next is your favorite new trend.
It's funny, you and I were joking about this before the podcast started. I'm just trying to cook a lot more. I think eating out has become way too much a part of a long work life and a busy life. So I'm just trying to be a lot more prudent with what goes into my body and doing a lot more of the cooking at home.
I find it so therapeutic, especially with 2 young kids at home, like just to stand there and cook and make all this stuff. But also having all the food made, like meal prep on like a Sunday and put it all in the Tupperware. And just have a bunch of like, you know, like you walk into a nice salad bar and you have all these different options to pull from. Like, that's what I want my fridge to look like. You just pull out all those pre-made grilled veggies and stuff. That's awesome that you're doing that. Next is your favorite book.
The Score Takes Care of Itself, Bill Walsh. Really good leadership book and principled book about how if you do the right things, then, you know, the right things will happen to you and the score will take care of itself.
Famous coach, if our listeners don't know who that is.
Big football coach, big NFL for any 49ers fans out there. But big NFL old-time football coach.
Amazing. And last but not least, your favorite life lesson.
Favorite life lesson would have to be, don't worry about things outside of your control. There's so much outside of your control. If you just focus on what you can control, I think that'll just bring you a lot more happiness, probably.
Dr. Silva. That idea of also not looking at successful entrepreneurs in a negative light is a hard thing these days, especially for billionaire entrepreneurs who came from nothing. A lot of immigrant founders came from nothing,
Right.
but now because they're successful billionaires, they're only being judged on that, all the things they have done and where they had to go to get there.
Right. What does startup DNA mean? It means learning how to iterate. It means learning how to fail. It means learning, taking the learnings from that failure, learning how to learn from success. All of the journey, the roller coaster, all of that is a part of like what makes the startup model and the entrepreneurial model. That's like why it's so powerful. Yeah, you can criticize people for success, but I mean the journey is what is what can make all of these other kinds of applications of entrepreneurialism so powerful.
I could talk to you forever about this, but I got one last question before we jump into our fast favorites. How do you sleep at night? You've got so many things on the go. What do you do to keep yourself mentally and physically healthy, and how to stay motivated?
I mean, I do a lot of fitness-oriented kinds of things. I think that's sort of necessary. It's like you have to like put in energy to get energy, right? So that's for sure. I invest in my spiritual life, those are I think the things that help me sort of keep pace.
Meditate every night, every morning?
I would in the morning.
Okay.
Yeah, it's prayer in the morning.
Cold tub?
I do love that. I don't have one at my house.
I got one and it's the best thing every day.
Do love it, yeah.
Okay, cool. First off, your favorite podcast?
I love 20VC with Harry Stebbings.
You
I was
were on it.
just on it. Yeah, he
Great episode.
just did an interview with the CEO of Shine.
Yeah.
That was great. He's amazing.
You were great on that one. Next is your favorite newsletter or blog?
I'm like I love American politics and the whole discussion and insanity of it. So I love Silver Bulletin with Nate Silver.
Yes.
Yeah.
That's a fantastic one. This one, as a tech CEO, is it going to be fun? What's your favorite tech gadget these days?
Because of the fitness orientation, I have multiple in-body devices. It's like fat and body composition analyzers, and I'm on the hunt for what's the best. Because like the rings, the bands, like they're all evolving to be able to give you that too. So
I just got a smart scale. Trying that.
yeah, that's like that's the in-body. Like I have like a really elaborate one in Montreal and a smaller one in LA.
Next is your favorite new trend?
I think I love the trend towards meditation. I think everybody should be meditating in a black hole, and that's why I created a mobile version.
And next is your favorite book?
Good to Great is amazing. I think that's a little bit the journey, since a lot of the execs at Lightspeed are reading it. I think it's is it Jim Collins? I'm actually listening to the audiobook as I fly around right now.
Your book is coming out in 2025. It's Age of Union?
No, Age of Union's my last book.
Okay, what's the newest book called?
TBD.
It'll be out in 2025.
Yes.
Excited for that. And last but not least, what is your favorite life lesson?
The journey is the reward, Steve Jobs. I think you can't be so fixated on what I'm only going to be happy when we get here. I can tell you from all the different stages of all the different projects, and especially Lightspeed, that you have to enjoy the journey. There's no golden age to have been at Lightspeed. It's always an amazing moment. Like, enjoy the journey. That's what it's about.
Awesome. Well, thanks for joining us in the Tank today with Dr. Silva. Hey everyone, thanks for tuning in to another episode of Tank Talks. We hope you found today's conversation as insightful as we did. If you're enjoying the show, we've got 3 quick things to ask of you. First, hit that subscribe button on your favorite podcast platform so you never miss an episode, whether that's Apple Podcasts, Spotify, Google Podcasts, or YouTube. Next, follow us and stay up to date on upcoming episodes and behind-the-scenes content on social media with Twitter, LinkedIn, and Instagram. And lastly, share the love. If you found value in today's episode, share with a friend or colleague who'd benefit too. Your support helps us bring in more amazing guests and keeps the Tank Talks engine running. That's it for today. Until next time, keep disrupting and innovating.